Exchange-traded funds, ETFs, have become one of the most popular investment options in recent years, offering a flexible and cost-effective way to build a diversified portfolio. Whether you're a novice investor or a seasoned pro, ETFs can provide an easy way to gain exposure to a wide range of asset classes, sectors, and markets. But what exactly are ETFs, and why should you consider adding them to your investment strategy? In this guide, we'll break down the mechanics of ETFs, their benefits, types, and strategies for incorporating them into your portfolio. By the end, you'll understand why ETFs are such a powerful tool for achieving your financial goals. 1. What are ETFs? An exchange-traded fund, ETF, is a type of investment fund that pools money from multiple investors to purchase a diversified portfolio of assets, such as stocks, bonds, commodities, or other securities. ETFs are traded on stock exchanges, just like individual stocks, making them highly accessible and liquid. Key characteristics of ETFs. 1. Diversification. ETFs often track a specific index, sector, or asset class, providing exposure to a wide range of securities within a single investment. 2. Trading flexibility. Unlike mutual funds, which are priced only at the end of the trading day, ETFs can be bought and sold throughout the trading day at market prices. 3. Low costs. ETFs typically have lower expense ratios than actively managed mutual funds, making them a cost-effective investment option. 4. Transparency. Most ETFs disclose their holdings daily, allowing investors to see exactly what they own. Whether you're looking for broad market exposure or targeted investments, ETFs offer a versatile solution. 2. How do ETFs work? ETFs operate by tracking the performance of a specific index, such as the S&P 500, or a specific theme, like renewable energy. Here's how they work. 1. Creation. A fund provider creates an ETF by purchasing the underlying assets and grouping them into a fund. 1. Shares of the ETF are then issued to the public. 2. Trading. Investors buy and sell ETF shares on stock exchanges through brokers, just as they would with individual stocks. 3. Tracking. The ETF's value fluctuates throughout the day based on the performance of its underlying assets. Most ETFs are passively managed, meaning they aim to replicate the performance of an index rather than outperform it. However, actively managed ETFs, where fund managers make investment decisions to achieve specific goals, are also available. 3. Types of ETFs. A. Stock ETF. Stock ETFs invest in a basket of stocks, often tracking a specific index like the Nasdaq 100 or the Dow Jones Industrial Average. They provide instant diversification and can focus on large cap, mid cap, or small cap stocks. B. Bond ETF. Bond ETFs focus on fixed income securities, such as government bonds, corporate bonds, or municipal bonds. They are a popular choice for investors seeking steady income and reduced risk. Sector and industry ETF. These ETFs target specific sectors or industries, such as technology, healthcare, or energy. They allow investors to capitalize on trends in particular areas of the market. D. Commodity ETF. Commodity ETFs track the performance of physical commodities like gold, oil, or agricultural products. They provide exposure to these assets without the need to directly purchase or store them. International ETFs. International ETFs invest in global markets, offering exposure to emerging or developed economies. They help diversify portfolios geographically. Thematic ETFs. Thematic ETFs focus on specific trends or themes, such as artificial intelligence, green energy, or cybersecurity. These are often designed for investors looking to align their portfolios with future growth sectors. 4. Why you should consider ETFs. Say. Diversification. One of the most significant advantages of ETFs is diversification. By investing in a single ETF, you gain exposure to a broad array of securities, reducing the risk associated with holding individual stocks or bonds. Cost efficiency. ETFs have lower expense ratios compared to many mutual funds because they are typically passively managed. Additionally, there are no sales loads or management fees, making them an affordable option for investors. Liquidity and flexibility. ETFs can be traded throughout the day at market prices, allowing investors to react quickly to market movements. This flexibility makes ETFs an attractive choice for active traders and long-term investors alike. Transparency. Most ETFs disclose their holdings daily, ensuring that investors know exactly what they own. This transparency fosters trust and informed decision-making. Tax efficiency. ETFs are generally more tax efficient than mutual funds because of their unique structure. The in-kind creation and redemption process minimizes capital gains distributions, reducing the tax burden on investors. Accessibility. With ETFs, you can start investing with a relatively small amount of money. Fractional share investing also allows for even greater accessibility, making it easy to build a diversified portfolio on a budget. 5. Strategies for investing in ETFs. Say. Core satellite approach. In this strategy, ETFs serve as the core of your portfolio, providing broad market exposure, while individual stocks or thematic ETFs act as satellites to target specific opportunities or enhance returns. Dollar cost averaging. This involves investing a fixed amount in ETFs at regular intervals, regardless of market conditions. Over time, this strategy helps reduce the impact of market volatility. Sector rotation. Sector ETFs allow investors to capitalize on market cycles by rotating investments into sectors expected to perform well in a given economic environment. D. Income generation. Bond ETFs or dividend-focused ETFs can generate regular income, making them suitable for retirees or those seeking passive income streams. E. Long-term growth. Investors can use ETFs to build a diversified portfolio aimed at long-term growth. Index tracking ETFs are particularly effective for this purpose, as they offer exposure to the overall market with minimal fees. 6. Risks associated with ETFs. Say. Market risk. ETFs are subject to the same market risks as their underlying assets. If the index or sector they track declines, the value of the ETF will also decrease. B. Tracking error. Sometimes, an ETF may not perfectly replicate the performance of its underlying index due to fees, liquidity issues, or other factors. This is known as a tracking error. Century overtrading. The ease of trading ETFs can lead to overtrading, which may incur higher transaction costs and reduce long-term returns. D. Lack of control. Investors have no say in the specific securities included in an ETF. While this is usually not an issue for index tracking ETFs, it may be a concern for thematic or sector-specific ETFs. 7. How to choose the right ETF. A. Define your goals. Identify your investment objectives, such as income generation, capital preservation, or long-term growth. This will guide your ETF selection process. B. Assess expense ratios. Look for ETFs with low expense ratios, as these fees can significantly impact your long-term returns. Century. Evaluate liquidity. Highly liquid ETFs are easier to trade and have narrower bid-ask spreads, reducing transaction costs. D. Understand the holding. Review the ETF's holdings to ensure they align with your investment strategy and risk tolerance. E. Check performance history. While past performance doesn't guarantee future results, it provides insight into how the ETF has performed in different market conditions. 8. Real-life example, using ETFs to build a portfolio. Let's say you're a new investor looking to build a balanced portfolio with $10,000. You might allocate your funds as follows. 1. 40%, $4,000, broad market ETF, e.g., S&P 500 Index ETF, for diversified equity exposure. 2. 20%, $2,000, bond ETF for stability and income. 3. 20%, $2,000, International ETF for geographic diversification. 4. 10%, $1,000, Sector ETF, e.g., technology or healthcare, to capitalize on growth opportunities. 5. 10%, $1,000, Thematic ETF, e.g., clean energy, to align with your interests or long-term trends. This diversified approach allows you to benefit from various asset classes while managing risk. ETFs are a versatile, cost-effective, and accessible investment option suitable for investors of all experience levels. They provide instant diversification, low costs, and the flexibility to trade throughout the day. Whether you're building a portfolio from scratch, seeking targeted exposure, or enhancing your current investment strategy, ETFs offer an efficient way to achieve your financial goals. By understanding how ETFs work and carefully selecting the right funds for your needs, you can take full advantage of this powerful investment vehicle and grow your wealth with confidence.